Oh, sorry, there we go. So yeah, I'm sorry. Someone asked, could I rephrase the question? Okay, some advocates for selling Iron Condor suggest just doing them on the ETFs that are low volatility, so less movement. Others advise selling Iron Condors into high IV positions, IV rank or IV percentile positions, because you want to get that extra juice and that extra premium. Okay, so there you go, James. That's that. Okay, so the examples that Paul gave was IWM as an underlying as a current IV percentile is 0%, Roku's IV percentile is at 72. Which approach is correct? And, I need a lot more extensive testing on this. We are going to look at some testings as well and some brief reviews, but the concept is that positions that have a higher volatility, a higher implied volatility range, percentile rank, whatever you want to call it, they're going to be inflated premiums. You're going to see very high returns even in the range of probability that you want, 80, 85% out of the money or more perhaps. Okay, and if I have that higher return, an 80% probability should still be fine, right? Meaning that if I open 5 positions, I'll have an 80, 82% probability between in the Iron Condor or higher, and it's offering a 30% return versus an ETF which is offering a 10% return. I'm going to do much better. First, let's talk about an Iron Condor. What is an Iron Condor? It's a combination of doing a bull-put credit spread and a bear call credit spread on the same security for the same expiration. So on Roku at 128, an 82% probability with the highest return of 16%. This actually doesn't seem that high volatility to me. But in any case, with the 82% probability between, which is what we want, which does factor in the volatility, and the highest return of 16% for February standard expiration, 40 days away. I could sell the 80 put and buy the 75. That'd be a 5-point bull put spread with about a 20-cent net credit. At the same time, I might sell the 170 call and buy the 175. There's my 175 call there. There is my lower 75 put there. My 2 sells are right here. So I'm about, 42, 44 points out of the money in both directions. Now, I could go closer in and get a much higher net credit, but what did I want? I wanted the 82% probability. Based on how Roku is moving, the spreads with the 82% probability between is the 170 and the 80. There's an 82% chance it'll stay between those two prices in the next 45 days. So that's what an Iron Condor is. A benefit of the Iron Condor is that most brokers may only require you to cover one margin or the other, not both. So you're not covering the margin requirement of 2 5-point spreads. You may get away with just doing 1 5-point spread. Now, we could get higher returns in Roku, 30%, 40%, by maybe going to the 160 or 150 call and buying the, let's say 150, buying the 155, and selling the 105 and buying the 100. We might get close to a 60% return, not 16, but more along the lines on that 5-point spread of, let's say, a $2 net credit or so. So we get 60, 70% return. So why am I not doing that? Again, based on where the stock has moved. These prices, 80, 48 points away from the current stock price, 170, 42 points away from the current stock price, are the ones, that's the combination that's offering that 80%, 82% probability between, which I kind of need to be successful in this strategy, or with just bull puts, or with just bear calls. Here's 6 months of Roku. And what did I mention? Well, we were about 42, 48 points away for a 40, 35-day trade, down to the put, up to the call for our Iron Condor that we just saw. Well, had I opened the position here after expiration for the next standard expiration, when Roku was around 105-ish, by the next expiration, it's up to 145, 150. So I might have breached this level. True at the end, but there's that sudden spike here, and that probably would have caused me to close the position for a loss or not roll it out. So let's say I opened the new position here, following the next expiration, following the next standard, the Monday following the next standard expiration. We hit 40 points. Well, I got in at about 145. Here we're at 175, so it peaked up about 35 points. It's getting close to our trigger. Okay, so maybe we left it alone, and then we're down here. Okay, it's at 130. This spread might still look good. But what if you open an Iron Condor, even 40 points apart at the first of the month here? You were closed out before expiration because it dropped from 170 down to about 105 at that point, or even 110 here, 115, and so forth. Enter a position here. Are we 40 points up? Yep. Enter a spread here. Not 40 points up. This would have probably been a good Iron Condor, but we went up and we came down quickly. I went from about 130 to about 115. Not too bad. But again, what's happening this whole time? What's happening this whole time is that IV range that Paul is looking for is changing. It's not to say that Roku was at the range he'd want here, following that high IV range, or here. But you just look at, again, the structure that we want for an Iron Condor position. We want no real movement one direction or the other. Now with the IV range high, we had to go 48, 45 points out of the money in both directions to get that 82% probability that we want to be successful with credit spread trades. That's what we need. We've shown many webinars before where going for the 30% returns, 28% returns on bull put or bear call credit spreads with only a 70 or 75% probability doesn't work out over time. You take too many losses, and unless you get up to 77, 78% success rate, you're not profitable. You need to target more for that 11, 12, 15% with an 83%, 85% probability to be successful long term. The same goes with the Iron Condors. A higher return without that good probability that you need, if you're not at that success rate, you won't be successful. The losses will wipe out the gains, even if you're taking in a 30% return, 40% return, or higher. So what about our other comparison on IWM? Well, let's say 164. We saw Roku was only at 128. Here we're at 164, but we ran a search, and we looked for, following Paul's example of IWM, the lower volatility one at 0%. But at 164, 42-day out spread, we'd be selling the 175 call and buying the 170. This is just a one-point spread. The returns are what matter, but a 175, 176, and selling a 153, 152. We're only 11 points away instead of 40. But because of the lower probability, this still has the 82.5% or so probability between, so we don't need to go as far out. But the return is less. It's only 13.6%. Still a good return for a one-month credit spread, 2-week credit spread too. But this is a 1 month out, 45 days out. But that's what we expect with an ETF, isn't it? If we go 30 days out or 14 days out, where I could expect, let's say, a 15% return on a stock with a good volatility for a 2-week out trade, I'm expecting 7 or 8 on the ETF. 1 point, 2 point, or 3 points doesn't matter. That's what you're expecting to get the right probability. Okay, so 11 points away. Do we see big moves here? 11-point moves on IWM or that same 6-month period? Sure, here's one. We dropped down from 158 to about a month later down to 145. That's 13 points, right? So that was a move. And this one was a little bit sudden. But then we don't really see some of it as it goes back, but then it's coming down a little bit less, and it's going up here, so it might be threatening the bear call, but are we going up 11 points? We're going up from about 152 to 160. It's only 8 points. Here's another big move. It's only 4 points. Here's another big move from 162, but it's another 5 points, right? You don't get those sudden spiky movements with the ETFs. It might have a strong run to threaten the bear call side, or a sudden drop to threaten the bull put side. But those more volatile stocks, those moves happen more often, and they're more steep. So is there really a clear answer, one or the other? Well, and just for Paul, tried to do my best with the time that we had right before the webinar, and here's what we've got. An Iron Condor search and power options, looking at the higher IV stocks, higher IV percent range. We just do a basic Iron Condor search for any positions that have this higher IV range. It's mostly therapeutics, biotech stocks, a couple things. Yelp, I think, was in there, but I'm not sure if it was the right IV percent I was looking for when I saw that one come up, so I took it out of the results. But in any case, searching for positions with an 82% probability between, and also an 80% probability above the short put and an 80% probability below the short call if you're just to do the bull put side or the bear call side. What does the same margin mean? It means on both spreads, the bear call and the bull put, I used a 5 or 2 or 4%, 4-point margin. It had to be the same margin on both spreads. 45-cent minimum net credit for 30 days out in time. From November to December 2018, on this higher IV screen for Iron Condors, 15 of the top 15 results were success, 100% success rate with an average return of 64.4%. Like I said, biotech stocks, I might have had a phase 2 or phase 3 coming up, but all of them were successful. December to January, only 6 out of the top 15 were successful, and the average loss of if you'd opened all 15 trades with equal money was 48.7%. So what does that mean? If I had started with $1,000 and allocated it to these 15 Iron Condors, if I made a 64% return, I'd be up $640, excuse me, or at $1,640 in my account. I take that money, invest it into December and January, and it falls 48.7%. That's $798. So we went up from $1,640 and then lost almost $800, so we're down to $842, down 16% from where we started. Now, we're not going to talk about triggers. We're not going to talk about management here. We're just looking at a basic return of what you'd expect. And believe it or not, this is what I expected. This could have come out to a profit, and I wouldn't have been surprised. This could have come out to a loss, and I wouldn't have been surprised. Okay, because it's going to go this type of portfolio, credit spreads, Iron Condors, debit spreads even on stocks with higher volatility rank, trying to go for the higher return. Even if you have that probability that you want, you're going to see shifts of up 30%, down 20%, up 25%, down 35%. It's going to be all over the map because, pause the screen here real quick and go back a couple, I'm sorry. All right, there we go. Because why? Because this is what those types of stocks do. They have that higher IV rank and IV percentage because they're fluctuating all over the place. So you'd expect with any strategy, even if you just did the bull put, or you just did the bear call, or you combine them to an Iron Condor, you're just going to have wild swings all over the place. What do I really want with an Iron Condor? A stock that kind of maybe just does this, or maybe it can even just do this over that 6-month period, as long as it's slow and gradual and it's not all over the place. You could make profits with this. You've seen the opportunity, right? We saw that 1 month, November to December, with the ones that the highest return ones that came out would have been a 64% return in 1 month, average for the top 15 trades. That's fantastic. That's phenomenal. Only to give it all back. That's also possible in the very next month, or worse. Give more than that back. Give more than half of what you had back. That's it. All right, and for the ETFs, well, if I'm going 45 days out or even 30 days out, what can I do? I can't expect a 45-cent net credit on a 5-point spread and expect to see an 11, 12, 15% return with the same 83% probability we want. Can't see that. So we had to lower the expected net credit and lower the expected return. Same probability, same time frames, but just looking at IWM, QQQ, SPY, and DIA, those standard ETFs. November to December, 3 out of 4 success rate. Average return was plus 4.7%. That's what we expect, right? 5, 6, 7% returns. We took a loss on one of them, so it lowered the average return from 7 or 8% that we might have seen on all of them down to 4.7. December to January, 3 out of 4 again. Average of 3.2% return. So over that 2-month period, we start with $1,000. The first month, we go up to $1,047. Get a 3.2% return. That goes up $33. So we're at $1,080.50. So up $80.50 after 2 months for an 8% return. Slow, gradual, half, a third, if not a fourth of the returns that you'd expect to see on the more volatile positions that you're looking for, the high IV rank, high IV range. Ending amounts 16% down after 2 months for those high IV percentages. Just looking at the top 15 here, up 8%. Yeah, can we really make a conclusion from this? No, it's a minimum sample size. And I only looked at monthly. I didn't bother to do weekly. Or what I prefer to do is 2 weeks out, just like I do with bull puts rather than the Iron Condors. But honestly, these are the results I expected. Trying to target high IV range stocks for things such as a credit spread, debit spread, Iron Condor, even just buying a call or buying a put, you're going to have to expect wild swings in your portfolio or in that portion of your portfolio, because that's just what happens. They're designed to do that. That's why they fluctuate. That's why the premium is higher, because of the inherent risk of trading on a position that tends to just swing wildly, whether due to different market conditions, different competitors, market sentiments, what have you. What do you expect with the ETFs? Lower return, higher success rate. And I don't mean ending portfolio, I mean higher success rate. So we are 15 out of 15, 21 out of 30 success rate, of course, on the, my apologies, 21 out of 30% success rate for the 2 months on those higher IV percentile rank Iron Condors, where we're ended up 6 out of 8 or 75% success rate on the ETFs. So which is better? Paul, only you can answer that question for yourself. Because even if you can expect to potentially see higher returns with the higher Iron Condors on the higher IV range stocks, but you have to be able to stomach the wild swings. And I mean down as much as 40, 45, 50% in that portion of your portfolio at some times, maybe even more, with the expectation that the next month you might make 40 or 50% on what you invest because of the high return. But you're going to be all over the map. This is what is designed when you look at the Iron Condor and say, what would I want? I want something stable to neutral, neutral to bullish, neutral to slightly bearish, that doesn't have wild swings, because that's the structure of the trade. You don't want the stock to be going over this strike, below this strike, back and forth, back and forth. Just want something nice and easy. May not give you the best return that you want, may not give you the highest return you're expecting, but again, that's what you do it. And I know a lot of you got comments that came in, but I think I just saw one here from Chuck. And Chuck, I saw your question about debit spreads today. I haven't had a chance to answer it via email. 2 webinars today, so I've been have my hands tied with those, and the first one lasted over an hour and a half. But in any case, Chuck says, that's why I prefer credit spreads with a directional bias coming from others. And Chuck, that's me too. This is why I haven't traded the Iron Condors in about 4 years. And it's simply because if you look at the market conditions, let me pause the screen real quick here. Yeah, we're going to navigate over to power options anyway, so might as well do that now. Let's see here. Here we go. Okay, so, oh, sorry, here's the results from that first month, from the historical testing. Oh, I can't see it. It's not full screen. Oh, sorry. There you go. So this is showing you the 3 out of 4 with an average 4.7 success rate for the 4 trades from November to December. 10.3% gain, 10.3% loss, essentially negate that. So 2 9% returns over 4 trades, almost a 10 and a 9 on that one. And that was the testing that we did. Oh, sorry about that. I needed the other screen. Hey, fantastic. Okay, there we go. All right, so another portion to you, Paul. Let me just show you this. This is the higher IV range sort of Iron Condor search we created today, and I don't know if all of them match your needs, but they're all ones you'd expect. So you look at these returns, 87, 86, 56, 54. On what? Intracellular Therapies, Sage Therapeutics, Scorpio Tankers, Yelp, Trade Desk. They have the probability, they have the inflated returns, but it's mostly going to be pharmaceuticals, biotechs, some things that have a higher movement. Wayfair came up there as well. And that's what the search was when we looked at the top 15 from November to December and December to January. To the comment that was just made in regards to what Chuck mentioned, we'll just use SPY as an example. Just going to go to the stock chart for about 4 years. Okay, so here's 3 months there. That doesn't look too bad, actually. This looks like nice steady growth, as we all know. We've seen that. But I'm going to take this back 4 years. And this is pretty much the reason why I haven't traded Iron Condors in the past 4 years. I've just been focusing on bull puts. If I broke this down year by year, and we did this in another webinar, you'd see that this movement here was so fast, and that 3 or 4 month period here at the beginning of 2016, you would have been taken out on the bear call side just about on every trade. You have some good positions here, but then your bull puts would have been threatened. Had some good success here, bull put sides being closed again. Good, too fast of a rise here. Good, good, good. This here takes out all of your bear calls. Now what happens when you're losing on one side of the spread or the other? You're wiping out 5 previous wins. Okay, and this is so fast that that's what's happening. Oh, and then that February decline there in 2018, guess what? Bull puts are all gone to 50, 60% loss. How do I know that? Because I was in bull puts at that time, and that's what I experienced. But then it recovered fast again back up in 2018. So if you opened them right after the drop on the bear call side, you would have been closed out again. Then we had another drop. Take out the bear calls. This was a good period, and this was a fast rise here through September. It would have taken out about half of the bear call side. And then October, November might have been okay, but that October drop and that December drop, you lost on all the bull puts. So literally what I'm looking at here is 1, 2, 3, 4, good period, 5, 6, 7, 8, 9, good period, 10, 11. 11 time periods where I likely would have lost more than 50% on the bear call side or the bull put side just as a general strategy, even going with 80% probability because those sudden moves over that 3-year period. Beginning of 2019, you probably would have been taken out of the bear calls right away. That was such a quick rise, wasn't it? And then here you might have lost in some bull puts, but here you would have been good. Here would have been questionable. Too fast of a rise. Might have been moving those bear calls too much. Here, hopefully safe, not too bad. Here you're getting threatened on the bull puts. Quick rise up, might have lost on the bear call side. Quick down, might have lost on that. And this was just a rapid increase in the last 3 months where I know investors who were doing bear calls thinking the market correction was coming. 85, 88% probabilities were managing those bear calls on even indexes as well as standard stock positions. So what do we want? We wanted more of this. And I know that looks like the trend line, but with all the hiccups in between, and some of this was way too rapid, that's why I haven't traded Iron Condors in the past 4 years. As Chuck mentioned, I've been solely directional. When I see my trend change, I just don't do the bull puts, don't do the bull puts, don't do the bull puts. Oh, I'm sorry, I got closed out for losses here on the bull puts. Was fine here, stopped here, was good with bull puts here, but didn't do any bear calls on other stocks I thought were more bearish. Lost a little bit here. Okay, so I mean that's kind of the concept that we're looking at. What is the structure of the trade as opposed to delving into what is better, higher implied volatility to get the higher returns, knowing I'm going to take more losses, or is it better to have something that matches more the direction of the position? The real answer is, Paul, it comes down to you. Knowing that if you get into positions with that higher IV range in any form of credit spread, any form of Iron Condor, anything along those lines, you're going to have wild swings in your portfolio. So what do you want? Wild swings in your portfolio with the potential to have a higher return, but knowing that you're going to have to stomach large losses, and who knows when that large loss might actually trigger you out of the strategy, or something more gradual that you know there's positions out there that might have double, triple, or even quadruple the returns you're looking for, but at least you're going forward with them. Okay? All right, so that covers that concept that I have in Iron Condors. More extensive testing is needed, but again, as Chuck mentioned, this is why a lot of investors start to gravitate away from the Iron Condors during questionable market periods or expected times of correction or things of that nature, because although the return, you get a double credit and you think that's better, there's no point getting stopped out 50% of the time in one direction or the other because you're in the wrong structure. You need something that's neutral, and the market's not being neutral.